Okay. Good morning, everyone here at the Investing Stuff You Should Know podcast. We have a fantastic guest with us today, Drew Dolan. He's out of Albuquerque, New Mexico. I've been interested in myself in the Albuquerque market this past year. It's got a lot of interesting things happening, a lot of investment from Netflix and Facebook and these different things going on. So Drew looks like he's been there for quite a while. So we're going to let him explain why he's there and what he's done. And we're just going to jump into it. And he's also the president or has been the president of Titan Development. He's a fund manager, all kinds of cool things that are relevant to what we talk about here. So Drew, welcome.
Hey, Johnny, thanks. Nice to be here.
Beautiful, man. Beautiful here. So let's, I see there's also some commonality here between you and I as an engineer. As I get into the space, there's more and more of us that I find. What pivoted you? Let's just talk about that for like just a brief second here. You were an engineer and then you became a what and why?
Yeah, I was one of those engineers that got the degree and then wondered, what the hell am I going to do with this degree? Because I really didn't want to be an engineer. And so I went to work for a company called Trane, Trane, and they only hired engineers to design HVAC for commercial buildings and sell it. And it was really a sales job. It was 100% commission sales job, first job out of college. And I loved it. You could work as hard or as smart as you want, and you could make as much money as you worked hard and smart. And I did that for about 6 years in San Diego, which is a great market to be in when you're in your early 20s. I was born and raised in New Mexico, went to school in Arizona, went to Arizona State. And, after, kind of 6 years with Trane, I realized I had a couple developers as clients, and they were having more fun, making more money, calling the shots on deals versus the architects and subcontractors, engineers I was working with. And I'm like, I want to do that. That's what I want to be. And so I moved back to New Mexico, and I was, lucky enough to get partnered with a great guy who became my mentor and run that out for about 15 years. And I think the unique advantage for me jumping into development was I didn't really have any specific skills that were relevant, other than being a salespeople and connecting.
Oh, I like that, man. I like that. So you didn't come in with all these preconceived biases, right?
Yeah, I wasn't a civil engineer, so I never got pegged into that bucket. I wasn't a lawyer. I wasn't an architect. Like, I just could do anything and everything. And I really gravitated toward raising equity and structuring deals and joint ventures. Like, that's what I really loved. And that's where I, made the most of my early career for sure.
Amazing, man. And a lot of people, especially emerging fund managers or people stepping into the space here, what was your journey of and how did you connect with this one particular partner that you are the kind of the founder and also, like you said, your mentor?
Yeah.
How did you connect with them?
I was really lucky in that my dad was a commercial banker and he knew all the developers. He knew he couldn't get me a job, but he knew he, could introduce me to all of them.
Yes.
And I met all of them, and it was just clear, this one group guy was doing more than everyone else. I took an 80% pay cut to start doing that because I was making a really good commission.
They're
but I knew that
selling air conditioner and things like that in hot climates. It's kind of like, it's like selling ice at a derby. It's like, wow, it's going to sell.
Totally. We did Qualcomm data centers and big biotech facilities, and I took an 80% pay cut to really invest in myself. And I think it took me 2 years before I was productive. And I really think it took me 5 years before I was honestly making money on my own and thinking. And that might sound like a long time to people, but it goes by quick when you're learning something new every day and you're always pushing yourself. And it was probably the coolest thing about that opportunity is I never got tied down. Nobody ever said no. I just got to do things and explore things, and it ended up, being very successful for all of us.
That's amazing, man. And I second that as well. I've made a few career shifts myself, and yes, it does take a year and a half to 2 years before you actually feel like there's actually output. You're being productive in something. So like you said, 2 to 5, but yeah, like, just like contributing and then actually creating value is like another, like there's, I mean, I'm sure we can
Yeah.
break it down like this next couple levels, but that maybe that 5-year mark where like you were like the man and you're like doing stuff and you're leading with creating value. That's another level besides just being like competent. So, but yeah, I don't think that's strange at all here. So let's step real quick into I see this fund manager. So that's something that I'm interested in. I'm currently in that myself. What was the link between this kind of this, eventually became president of Titan and, started leading probably most things or a lot of things. And you probably there's a lot of shared roles. And then you actually decided to become a fund manager. Well,
Yeah.
how was that journey and what does that mean?
Well, we were raising equity from high net worth and family offices on a project by project basis. We were also doing some mild or light institutional partnerships. And a couple things. One, when you're on the hamster wheel of raising equity, you never get off. And your investors, sometimes they put a lot of money into one deal and a little money into another deal, but the one they put a lot of money in went okay. The one they put a little in went great, and they didn't get the diversity. And so in order to do a couple things, one, meet a lot of new investors. And in order to, give our investors diversity, we went out and put a huge pipeline of projects together. And we said, let's go raise, $100 million to feed that project pipeline.
Yes.
So we could raise equity once and then have equity for three years and then do it again. And for our investors, projects that overperformed balance out the ones that underperformed, and they got a really great diversity across the whole portfolio. So we set out to do that. I was a co-fund manager for a couple of years and then fund manager for a year. And, we had a lot of great investors. We were very diverse in what we invested in. It was multifamily, self-storage, industrial, senior living. The self-storage performed extremely well. The multifamily did really well. Senior living's been tough just because of COVID. I mean, just in general, it's been a really tough asset class.
Yes.
And, in stepping into storage, I got to know a guy named Corey Sylvester, who he and his partners created a program called Radius Plus. Radius Plus is the premier data source for everybody in the self-storage industry, whether you're a broker, developer, owner, operator. They're the only ones that have identified all 55,000 facilities. They're the only ones that scrape the web of 35,000 of those every day to get rates. And I was using their data. They're just, they're basically a tech company that stumbled into storage and realized there was a hole for that data. And I became incredibly enamored in what data could do, well, for any type of real estate.
Yeah.
But it was especially applicable for self-storage because of just what a commodity asset it is. And that when, Jody, you want storage tomorrow on Saturday, and you look it up on the web tonight, you're going to see how far is it away from my house? What's the price of that unit? And is that unit size I want available at that facility? And you really don't care whether it says public storage, extra space, or Joe's storage for the most part, as long as they're safe and secure and get good access. But
that's true
because of that commodity aspect of it, you can use data at a really high level to really scale and make investment decisions that I don't think you can do with other asset classes.
That's amazing, man. Let me ask you one particular question there. So we know CoStar is a very comprehensive data set. I guess I don't know for sure if they really touch or dabble into the self-storage here. But then you saw a hole. Is CoStar really focused just like, maybe you know this, maybe not, but are they just focused in the multifamily, or is because like you said, Radius Plus is so niched into storage that they're actually pulling out additional data that somebody like a CoStar or Reonomy doesn't have?
Yeah, good question. I mean, I hear a lot of feedback from people that CoStar is not necessarily the most accurate data.
Same here.
Axiometrics, are you familiar with Axiometrics?
I'm not, no.
So that's a multifamily software that tracks existing, new construction, planning, lease up. Are you familiar with Star for hospitality?
Yeah.
So Star is also something that does it for all the hotels. And Radius Plus is like those where it's very specific to the self-storage industry and it's very focused. I don't believe that I've never heard of CoStar doing anything data-wise for self-storage in terms of facilities and new supply. There are other programs that do it, but they're a far cry from the accuracy and the completeness of what Radius Plus did put together. And what they ended up with was the industry's only supply data set. Nobody else in the industry knows where all the self-storage facilities are in the country. Nobody else scrapes 35,000 websites every day to get pricing. And
Yes.
why does pricing matter in self-storage?
Yeah.
Because it's like an airline ticket. And pricing changes for all the more sophisticated operators every day. Sometimes they even change it interday. They change it based on how many units they have left of this size, what happened this time last year, what other new facilities are open. And they're like airline tickets. If it's the last flight, the last seat on the last flight from New York to Vegas on New Year's Eve,
Yeah.
it's going to be expensive. Just like it's the last 10 by 10 on the ground floor in some hot market in Miami, it's going to be expensive. And the way to think about how the web works, so many people shop for storage on the internet. And essentially, if you don't have prices on there, if you're not publicly showing your prices,
Mm-hmm.
it would be like opening Kayak, looking for a flight, and Delta said, call us for price. And you're
Yeah.
not going to do that. You're just going to
No.
select which one ever has the price. And so the SEO and the internet has really reshaped how people search for storage. And that's a huge advantage for those that are very sophisticated.
That's amazing, man. Quick question for maybe a smaller operator, which I'm not in the self-storage space yet anyway. A smaller operator, is it profitable? So you layer on maybe the subscription to Radius Plus or some other kind of data and some analytics and a more dynamic pricing. Does that still increase? You still have increased margin by incorporating the technology into my little 150 unit in some small town in Minnesota? Will you still experience increased revenue from that? Or does it
Yeah,
only kind of work at
really.
scale?
There are software programs that help you manage and SEO programs that help you advertise and software that helps you price. I mean, that is not Radius, although they're developing a management software
Mm,
because there's a huge need for a more sophisticated platform.
yeah.
But, one of the reasons people get into self-storage is because the barriers are pretty low. You got a piece of dirt, you don't know what else it can be. It's not multifamily, it's not a hotel, bam, it's storage, and you
Yeah.
can do non-climate controlled, and that's relatively cheap, and you can operate it yourself. So storage, of the 55,000, 75,000 are still owned by mom and pops. I'm sorry, 75% are still owned by mom and pops. And
Oh,
so
wow. Yeah.
it does have, it's a very fragmented industry. And, what we're building are Class A, multi-story, climate controlled, and we have one of the REITs operate. So if public storage is operating ours, you wouldn't know the difference between public storage, one they owned and one we owned. It all looks the same, and we're going for denser markets. So I don't know if we as at DXD, DXD is a data-driven self-storage investor, and we've raised 2 funds so far. We're our first fund did 10 ground up development projects in major markets. Fund 2 will do 50 to 75 ground up or value add acquisitions. And what I really appreciate about the second half of my career is staying very, very focused, being able to go anywhere in the country, which is a huge advantage of ours.
Yeah.
But staying very focused, because I certainly learned in my early career doing a lot of different things. Senior living is less real estate and more operating company. Storage is all real estate, very little operational component. But
That's a great distinction there, Drew. That's such a good distinction there. If you pie chart it out, it's like, oh, like what am I good at? What is my team good at? Or what do I what do I want to focus in? Like heavier on this, lighter. That's an excellent analogy.
Yeah, I mean, industrial leans more to the real estate. Obviously, hotels leaned more toward an operating company. And I got a really broad exposure in the first half of my career, which I loved. But I certainly haven't, what attracted me to self-storage was the very unique advantage DXD could create by using data and some proprietary tools to look for investing opportunities. But just the business behind self-storage is incredible, and the growth story behind the sector is incredible. It's kind of unmatched in real estate, and you know I'm
Give us a
loving
few
every
numbers
bit of
there.
it.
Go give us this. You just get a little specific there. Give us a few numbers. You said like the growth story and the trajectory and something like that.
Yeah.
Just give us a few high level numbers. Like, hey, like why is this compelling? Why should you look into this? And
Well,
what are those numbers?
why is the business compelling? Because you can be running between a 60 and 80% margin. So you might have 1.5 employees or 2 employees,
Wow, amazing.
very
Yeah.
little utilities. Marketing is reasonably cost. So just running 60 to 80% operating margin is a really cool business.
That's amazing.
And then from a growth story, 15 years ago, 8% of the US population used storage. 15 years later, today, it's 12%. So
Wow.
that's a 50% increase in adoption over the last 15 years. And what I think is actually really, really interesting is, COVID caused massive disruption, which storage feeds on times of disruption. It does really well when people need to move for a job, or a son is moving home with their parents, or school's out and schools are closing and you need stuff for storage. So the sector did really well, but 50%, 50% of the people that rented self-storage in the last 2 years,
Mm-hmm.
they were brand new, had never rented
Oh my God.
storage before,
Wow. Wow.
which they might, they might only use it for 90 days or 9 years, but whatever, even if it's 90 days, once that exposure happens, the next time they move, the next time their parents move, the next time their kids move, storage is now just a option for them that they never had exposure to before.
Oh, that's such good insight, man. That's so good. Do you see that 12% growing even beyond that? Where do you see that growing in the next 5 years? That percentage of the population that will use self storage. Do you see that growing much?
Yeah. This is the $1 million question that if you get Ken Woolley, the founder of Extra Space, or some of the icons in the industry,
Yeah.
they will speculate that it's growing, but nobody knows. It feels like it's growing. I will tell you why I think the last 2 years has been really good for the sector. Number one, that whole stat of 50% brand new users is incredible. Number two, we're never going to go back to work from home like we did. I'm sorry, go to work. This work from home concept where you spend 2 days at home and 3 days in the office, or now you use your home as a home gym versus going to the gym every day. There's just so much more demands on our homes. So you're converting a bedroom to an office or a bedroom to a gym. And that's here to stay. That unique lifestyle is here to stay. And so I think that's going to help storage because people need to move stuff in and out of a home.
Yeah.
And then I think the third piece that is really bullish for storage is this just the cost of housing. Look at what rents have done, up 15% across the country nationwide. Look at single family home prices, and now you add in mortgage rates, and it's so hard to afford. And incomes have not kept up with price of housing. And so what has happened is that somebody that could afford a 3-bedroom apartment now can only afford a 2-bedroom apartment, but they have stuff for 3. And so instead of spending an extra $400 a month on rent, they'll spend $85 on self-storage. And that's what makes sense to them. And so, those 3 factors tell me that, storage has some legs. I will say, storage has an Achilles heel. And back to my comment of it's relatively easy to get into.
Yeah.
It does get overbuilt. It got
Ah.
overbuilt in 16. It will get overbuilt again. And that's a real, kind of a nightmare situation for somebody leasing up a brand new storage facility, because if you thought it was going to get X rents, but now the rents are X minus 20% or 30%, all while your interest rates are going up, all while who knows what's going to happen with cap rates and construction costs.
Yes.
Everybody thinking about getting into it, you'll hear this from everybody. And I'm not one of those people that says, don't get into it because we want to keep this secret for ourselves. Anybody that wants to get into it, get into it. But just be really careful where you're going to build. Make sure you really understand the drivers, dynamics, demographics around those sites, and make sure you don't have two other facilities on your heels that are then going to extend your lease up from 3 years to 6 years.
So good, man. So good. Let's talk real quick about how did you snag that? You said it looks like a strategic partnership with Extra Space Storage. You mentioned the founder of that. How did you guys? How did you connect over that? How did you kind of get on that? Sounds like a really cool, probably partnership.
Well, yeah, Extra Space is an incredible company. They in the first fund I ran, we did 6 projects. They were our operator, and they ended up buying 2 of them. I'm sorry, 4 of them. And Extra Space, that's kind of the interesting thing about this business is they will manage for a fee, just for a straight fee. And that fee could be 4, 5, 6% from any of the managers who like the third party. They do a great job. They handle a lot of the things that an owner that doesn't know the business can handle. They don't have a right of offer to buy it. It's not a joint venture. They can put equity into projects, but we didn't use them that way. And they were a great partner. They did a great job leasing it up. Like I said, you wouldn't know whether Extra Space owns it or we own it. So I think the stats, Extra Space manages about 2,000 facilities. And I think about 1,100 they own outright, and the rest are in joint ventures or they are in, just third-party management. And they like third-party management because they want to own them, and they know if they have a relationship with you, their chances of owning are better. And so, I shouldn't say, our partnership with Extra was not a JV. We didn't, do anything unique that they can't do with other partners. We just had them do 6 projects for us, and we were, had a great relationship, and they were a great operator for us.
Beautiful, man. Let's talk about the structure of the partnership real quick here. So, just so the guests or the audience and myself can understand here. So, and this is probably just common real estate knowledge, just so you can explain it here. So, the Titan development essentially build a project, was it the owner, and then the Titan Fund Management, was that basically, did that provide the capital? And then, of course, within that, then Extra Space kind of came in. Or I'll lay out that part, that kind of partnership, and how you guys best optimize how that worked.
Yeah, let's talk about it from the DXD profile, because that's
sure.
What we're doing, and that's what we're on our second fund. So first fund at DXD was 53 million.
It's a beautiful number. Beautiful number.
100% of the equity in 9 out of our 10 projects. We had one project in Hawaii that we brought on a partner who had experience on the islands. So we were 30%, they were 70%. But back to, the fund put in 100% of the equity. We hired our third party operator, mostly Public Storage, but we have Extra Space as well. And the way that waterfall works is we pay our investors 8% pref, and then it's 80-20 to a 12 with a 60-40 after that. We have a bit of a catch up built in that allows us to split some operating capital if it comes straight from operations versus a capital event, which is a sale or a lease. But that structure right there for our investors, they solve to about a, we think it's a, call it 18 to 22 net IRR, which over a 4 to 7 year period of time is an incredible IRR. You can achieve those in real estate. I think we started building and looking for sites prior to the COVID pop in rates. So I think in a sense we got lucky. we started this company at really the depths of the COVID recession pandemic, which I actually think was probably the best time to start a company because
Yes.
people had time on their hands.
Yes.
Our investors would pick up the phone and talk to us. We could
Because
travel
what else are
anywhere
they
in the
doing?
country.
What else are they doing,
Exactly.
Drew? Come on.
They got to stop watching news for a little bit. And what turned out to be something I was nervous about turned out to be a huge advantage, which is, starting something when nobody else is thinking or doing something. And if we can do it during that period of time, we can do it. That's just a huge moral boost to the success of the program and the people just doing it in such a unique time frame.
Oh, that's so good, man. That's so good here. So, well, thank you for kind of breaking that out, how that structure worked there. There's a lot of the, I guess, let's just talk about a little bit about your investor base into that 50-ish, you said 53, but 50-ish million into that first fund. And what you tapped, who was kind of your top 5 sources of income or capital for those? Is it like family offices, high net worth folks, insurance companies, IRAs? Like what did that look like? Kind of that, just kind of speak through that profile.
Yeah, it was not institutional players because it's really difficult for a first fund. The institutional world of pension and sovereign wealth funds and state funds, they want to invest big chunks. They need you to be a $250 million investor. They don't like first funds. They want to write a $50 million check. I mean, it takes a long time. Anybody that's thinking that they want to start a fund and they're just going to go the institutional route, it just doesn't happen. I don't want to say don't do it, because there are some groups like Texas Teachers has an emerging fund manager platform, but it is very, very challenging. And so our network, or my network, is high net worth, family offices, some smaller institutions. And we've got investors from probably 15 different states, a couple different countries. And really what it is they believe in you. They think you're going to be successful. They like your strategy.
Yes.
And it's very much a trust-based decision. And that's where track record comes in. And what's the structure look like? I mean, we never had to negotiate on our structure. It was kind of a take it or leave it structure.
Mm-hmm.
But I think the structure is reasonable enough based on the value that we create that everybody was excited about it. But I think we're in the very early innings of an enormous amount of capital coming into commercial real estate. And the way I think about it, and I just look at the number of podcasts or groups like Cadre, Fundrise, Origin, CrowdStreet that are giving exposure to people who have never had exposure,
never even thought about it, or like they barely, they're like, barely they bought their first car, maybe. The first loan they've ever had in their life was maybe a car loan or something, and all of a sudden they're like, going to invest in real estate.
Yeah, totally. It's going to be an enormous opportunity, because for us, in our world, you had essentially the institutional players, and they had a lot of money, but there was nobody else that really, unless you went public,
right,
which is hard to do.
Right.
But now you've got, we all have an ability to scale with a lot more high net worth. And I think the stock market has done extremely well up until late. Cryptocurrency has done extremely well up until late. And, you think about all the meme stocks and Reddit and stuff that happened. I mean, people just have a whole new outlook on investing. And in real estate, you don't get 10x pops or 4x pops. That just doesn't happen. I mean, we've had them, but you get more lucky than anything. You got to be in the business for a long time. But what real estate does give you is inflation, for the most part, hedged, reliable income. If you've leveraged it appropriately, you've selected great markets and great assets. And, over time, you're going to do well. Time really solves a lot of problems in the real estate world. And the one thing that we use to our advantage that can also be a double-edged sword is leverage. We don't do anything without leverage. However, too much leverage will completely crush deals if they don't go the right direction.
Yes. Yeah, that's a sword. You want a sharp sword. You want to handle carefully. Very, very effective, but also you can cut yourself. Final question here as we wrap this up, Drew. Thank you for just that last little bit there. That was really, really, really good. The combination of data, and I know we kind of talked about this, just maybe just wrap it up, because I know it's probably like DXD fund is kind of your focus and your baby. You're on to fund two. What do you think, if you had a recommendation to emerging fund managers, or either just fund managers or even capital raisers, syndicators, what would your recommendation be on that kind of this synthesis that you're finding so powerful of data and real estate investment? What would you kind of just a couple of points there?
Well, one, the bar is really low for you because for the most part, real estate, we build it, we operate it, we think about it like we did 20, 30 years ago. Even multifamily, when we got into it in 2011, when I got into it, it was about going out and kicking dirt. We got to walk the site. Let's go walk the site. Okay,
Yes.
good deal, bad deal. And we still do that in our world. And so at DXD, we still need to see the real estate. Real estate matters: visibility, access, field, neighbors, and you can't do that from Google Earth. But what you want to do is go look at the sites that check the box from a data perspective. That all the data from a new supply, rates, demand, new multifamily, new single family, new traffic, all those things, it looks good. Now we go walk the site. So when we go walk a site, we're looking for problems, not opportunities. And I think what DXD's done different is we don't start with a site. Like, here's a site. Some broker sent us this site. Do the metrics make sense for self-storage? What we do is we can look at an entire market and say, okay, here's the area. And in that area, here's the street and here's the land. That's what we're doing. And so we've got an ability to scale and look at scale that, our competitors are, kind of miles behind us. Not to say they're not doing great things and unique things themselves, but I don't think they're able to really compete from a data perspective. But to answer your question, you got to have something unique. What's your unique story? You can't be just another Me Too multifamily buyer in Mountain West markets, because there's 10 of you or 20 of you already.
Yes. And there's probably five more coming up right now as we speak.
Yep. So what's the unique? Are you good at construction? Are you good at adding on additional units in land? Can you build it for less? Do you have off-market deals? Are you sourcing something that you're not competing with 10 other groups? Because there has been so much interest in commercial real estate because it's done so well that prices are way up. And there's a bit of a shakeout on the horizon. Things can't stay the way they are with interest rates increasing and construction costs from a development standpoint. Where we are with rents and construction costs, like, it is a strange time for all of us that have been in this business for a long time. And I can't even project on where it goes, but there's going to be some kind of shakeout. And I think that in your strategy, you need to think of everything that can go wrong. And when it goes wrong, what are you going to do about it? Because if you're protecting the downside, the upside will always take care of itself.
Yeah. All right, man. That's a fantastic note to leave us on. So thank you for all the knowledge shared. And I thank my audience for listening to another episode of Investing Stuff You Should Know podcast, where we bring on fantastic and knowledgeable guests like Drew that have done so much in development, and across a wide variety of asset classes, and focusing now, of course, on self-storage and leveraging data, and him sharing all that knowledge. So Drew, thank you again. And hope to see you out there.
Johnny, thank you. Great podcast. Enjoyed it.
Yes, sir.